Understanding CRR, Cash Reserve Ratio. The key to banking stability. CRR, or the cash reserve ratio, is a crucial term in the banking sector. It's the percentage of a commercial bank's total deposits that must be kept as reserves with the central bank. But why does it matter so much? Let's break it down. At its core, CRR is designed to maintain the stability of a country's financial system. Banks must keep a specified portion of their deposits which they can't lend out or use for other purposes. This reserve is held with the central bank, like the Reserve Bank of India (RBI) in India or the Federal Reserve in the United States. So what does this mean for you? In simple terms, CRR ensures that banks have enough liquidity to meet sudden withdrawal demands. Without it, banks could run into trouble if too many customers try to withdraw their money at once. For instance, let's say a bank receives $100 million in deposits. If the CRR is 4%, the bank must keep $4 million of that with the central bank and can only lend out or use the remaining $96 million. The reserve requirement affects banks in several ways. First, it ensures that banks can cover daily transactions and unexpected demands. It also helps manage inflation and control the money supply in the economy. Now, you may wonder how the central bank decides the CRR. Well, the rate is typically set by the central bank based on economic conditions. If inflation is rising too quickly, the central bank might increase the CRR to restrict the amount of money circulating in the economy. On the flip side, during times of economic slowdown, the CRR might be lowered to encourage more lending and spending. CRR plays a pivotal role in monetary policy. Central banks use it as a tool to regulate the economy. By adjusting the CRR, they can either stimulate or restrict the flow of money, directly influencing economic growth. Let's take a closer look at how CRR impacts banks. When the CRR is high, banks have less money available for lending. This can lead to reduced credit availability for businesses and consumers. Conversely, when the CRR is low, banks can lend out more money, which could stimulate business activity but may also lead to higher inflation if not managed carefully. The CRR also impacts interest rates. Banks that are required to hold a higher percentage of their deposits as reserves may need to charge higher interest rates on loans to maintain profitability. This is because they have less money to lend out. Now, how does CRR impact you as a customer? Well, if the CRR is high, banks might limit the amount of credit they offer, which could make loans more difficult to obtain. On the other hand, if the CRR is low, loans might become more accessible, but this could increase inflation in the long run. But CRR is not just about money supply. It also plays a role in maintaining public confidence in the banking system. By keeping a portion of deposits in reserve, the central bank ensures that banks are prepared for emergencies. This creates a sense of security for depositors. The CRR's effect on inflation is significant. When the central bank raises the CRR, it pulls money out of circulation, which helps cool down inflation. On the other hand, lowering the CRR can increase the money supply and potentially fuel inflation if it's not closely monitored. It's also essential to understand how CRR affects economic growth. During periods of low CRR, banks are more likely to lend, which encourages investment in businesses, job creation, and overall economic expansion. However, too much lending without proper regulation can create financial bubbles and lead to economic instability. CRR and other banking regulations help balance the needs of the economy. For example, during times of high inflation, central banks may raise the CRR to cool down the economy. This helps prevent runaway inflation and maintains purchasing power. One more thing to note, while CRR plays a key role in a country's financial stability, is just one piece of the puzzle. Other monetary tools like the repo rate or reverse repo rate also influence the economy's direction. In conclusion, the cash reserve ratio is a vital banking regulation that helps maintain liquidity, control inflation, and stabilize the financial system. By adjusting the CRR, central banks can regulate the economy's money supply, directly affecting lending, interest rates, and overall economic health. Understanding CRR gives you insight into how banks operate and how central banks manage the economy. It's not just a number, it's a tool that influences everything from your savings to the broader economy. So next time you hear about CRR in the news, you'll know exactly what it means and how it affects you and the economy.